When I first started my investment journey, I felt completely overwhelmed. The world of finance seemed like a daunting and confusing place. I made mistakes, experienced losses, and felt like I had no real control over my investment. But then, after my first finance courses at university, I decided that I was going to take investing seriously because I believed it could be a path to financial freedom and a better future. In this video, I want to share with you the 4 strategies I wish I had known from the beginning, the ones that if I was starting to invest again, I would do to supercharge my investment journey. So when I first started my investment journey, I realized that I needed to set clear investment goals. It was essential to define what I wanted to achieve and align my investment with those objectives. Just like how managing my time effectively transformed my student experience, setting clear investment goals proved to be a game changer in my financial journey. Before implementing this strategy, my approach to investing was all over the place and aimless. But I thought I could simply invest without a clear direction, allocating my funds to single companies, which I heard in the news, and hoping for the best. But after completing my master's degree in finance, working in an investment fund for several years, and learning from valuable books that I've linked down below in the description, I realized that successful investors approach their investment with intention and purpose. By running my investment decisions through the lens of well-defined goals, I began scheduling my investments based on specific targets, like for example, investing $250 per month. I learned that it's not just about accumulating wealth, but also aligning my investments with my desired outcomes. So setting clear investment goals and allocations allowed me to make specific choices with my time, resources, and risk tolerance. Now let's move on to strategy number 2. As I continued my studies, I realized the crucial lesson of diversifying my investment portfolio, which I wish I had learned even earlier, maybe already in my high school years. Everyone knows the sentence, don't put all your eggs in one basket. But somehow we seem to forget this when we start investing, like I did. When I started investing, I observed others, followed their strategies, and looked at what was happening in the news and hoped for positive outcomes without really understanding the principles behind it. But in my exploration of investment strategies during my bachelor and master, I discovered a wealth of research that really highlights the importance of diversification in optimizing investment results, while also at the same time minimizing risk. So let's imagine 2 investors. One is investing in one stock alone, let's use Tesla as an example, and the other one is investing in a diversified portfolio, for example an ETF of the S&P 500 index, in which we have among 499 other companies also Tesla. So now let's imagine something bad would happen to Elon Musk, for example. What would happen to the first investor? The first investor only investing in Tesla would probably lose a lot of his wealth as the stock plummets. The second one would barely notice the impact in their portfolio as they're investing in 500 different stocks at the same time through the ETF. This is really the power of diversification. You can minimize the company risks while still participating in the upside as a whole. You can even take it a step further and diversify not only within, but also between asset classes. So not only within stocks, like an ETF on the S&P 500 index, but also between asset classes like stocks, bonds, commodities, and other ones. With diversification in your portfolio as a tool, you are better equipped to weather the storms of the market and therefore also the market volatility. While continuing to navigate my investment journey, I discovered that a long-term mindset is key to investing, which is strategy number 3. So before we start, please hit the like button. It would help me a lot with the YouTube algorithm as well. Like most paths, investing isn't about quick wins, but about sustained growth over time, letting compound interest do its magic. So initially, as I mentioned already, my portfolio was filled with hot stocks, promising immediate profits, kind of like a fast food menu, tempting, but not really nutritious. However, my personal experience and insights from investment classics like A Random Walk Down Wall Street by Burton Malkiel showed me that the best investors focus on long-term growth. With a long-term mindset, I began to see my investments as seeds that needed time to grow rather than lottery tickets. This perspective really helped me make informed decisions, remain calm during market fluctuations, and even use downturns as buying opportunities. Also, during my years at university, I learned one of the most valuable lessons, strategy number 4, which was the importance of exploring different side hustles. Looking back, I realized that I had an incredible opportunity to tap into my entrepreneurial spirit and leverage the abundance of time I had as a student. I started to embrace this idea in my second year when I began tutoring students alongside my studies, helping them pass and excel in their exams. What began as a small effort helping fellow students at the time quickly evolved into a paid side hustle for me. I joined a tutoring company, teaching groups of students and gaining valuable experience, and as the time went on, I even had the opportunity to teach finance, statistics, and accounting courses at the university itself. These side hustles not only allowed me to earn extra income, but also provided me with a sense of fulfillment and personal growth. However, looking back, I realized that I could have explored even more side hustles during my university years. While tutoring was an important part of my journey, there were other avenues I could have explored as well. Looking back, I remember contemplating the idea of starting this YouTube channel during that time already, which was about 7 years ago. But the fear of judgment and concerns about what others might think held me back at the time. If you enjoyed this video on investment strategies I'd use if I were to start investing again, please give it a thumbs up and hit the subscribe button if you'd like to see similar content in the future. And if you're interested in learning how I use the 50-30-20 rule to manage my own personal finances, make sure you watch the video somewhere over here. Thank you so much for watching, and I'll see you in the next video.